Hey everybody, and welcome back to Investing with Wesley. In today's episode, I want to teach you what HELOCs are and how you can use them to generate a massive amounts of wealth in a very short amount of time. Let's get into it. All right, let's start things off really simple here. What is a HELOC? What does it stand for? What does it mean? A HELOC stands for Home Equity Line of Credit, and it is exactly what it sounds like. It is a line of credit that is tied to your home equity. Now, if you don't know what home equity is the amount of value in your home minus whatever debts you owe on it. So just for the sake of easy numbers, if you had a $100,000 home and had $10,000 worth of debt on it, you would have $90,000 worth of equity in that home. Now, having $90,000 of equity sounds really nice, but how do you access that? How do you get that equity out of your house? Well, there's three primary options and three primary ways to do it. The first one is to sell your home. You can sell your home for $100,000, use $10,000 to pay off that $10,000 debt you still had on it, and then your $90,000 that you had in equity now becomes yours. Now, not everyone's going to want to do this because now they're out of home. And chances are they're just going to have to put that equity that they got into another home so they can live in that home. So selling your home just to get equity really isn't all that good of an option. There is a second option as well. It's called cash out refi. You refinance the debt of your house and take cash out, thus increasing the amount of debt you have, but now you have some of that equity in cash in hand. And really, there's only two flaws when it comes to a cash out refi. The first one is that you lock in your payment. Now, sometimes that's a good thing, sometimes it's a bad thing.
Sometimes it may be good, sometimes it may be shit.
But also, because it's still an installment loan, whatever money goes in can't come back out. Every time you put $1 in there, it's considered a payment, and in order to draw any money back out, you have to refinance again. Now, the third option is the whole reason behind this video, and that is the home equity line of credit. Now, this is basically a credit card or a checkbook or just any sort of line of credit, except the credit limit is tied to your equity. Now, when it comes to interest rates, fixed interest rates at a cash out refi will always be cheaper than home equity line of credits. But the difference is in what you can do with your home equity line of credit versus what you can't do in refinancing your house and just taking that cash out. In ultra simple terms, a home equity line of credit is basically a credit card that is backed by your home. So instead of paying 20+ in interest like you would on a normal credit card, you're paying anywhere from 5 to 7% in interest. Now again, on a normal 30-year fixed loan, you could probably get 2.7 or 3% interest right now. So loans are always cheaper in interest than home equity line of credits. But let me show you why you might want to get yourself a home equity line of credit. But first, I need to teach you how a home equity line of credit works. And that is, there are two different periods or payment periods. There are the draw period and the amortization period. Now, usually the draw period is for 10 years and the amortization period is for another 10 or 20 years. During the draw period, you only pay the interest and not principal. During the amortization period, you pay both interest and principal. Now, during the draw period, you could also choose to pay extra and have it go to lower your principal, but the minimum payment required is only to cover the interest and not the principal. Only in the amortization period do you have to pay principal plus interest. Now, you could use your equity and use this credit card for any reason, really, just like you can with any other credit card. But choosing to use it in a consumer mindset is terrible, because in the event that you default on this credit card, you're at risk for losing your home. And really, when you think about it, is avocado toast and bobas worth losing your home? Not at all. But there is a really good strategy that you could use with this home equity line of credit to build wealth. And that's what we're going to talk about right now. You could use a home equity line of credit to buy other homes and then pay your equity back and then buy other homes. So as an example, currently I have $100,000 worth of equity in this house. Now, assuming I could find a bank that would actually give me the full 100% loan to value on this home equity line of credit, I could use that $100,000 to put 20% down on 5 different mobile homes. Now, currently mobile homes are about $100,000 a piece. Now, the 30-year fixed mortgage on $80,000 equates to like $465 a month. Now, Zillow says that they can rent for up to $1,700 per month, but I think that's just insane. So we're just going to go with a conservative safe number of renting this mobile home for $1,000 per month. Now again, up to this point, we've maxed out my home equity line of credit and spent all $100,000 in this draw period. But now I have 5 mobile homes paying me $5,000 a month. Now after paying the mortgage back, I'm left with a profit of $2,600. Now what I could do is spend that $2,600, or I can recycle and repeat. So that's what I would do. I would put the $2,600 back in as a payment for this home equity line of credit. And doing that consistently for 4 years is going to pay it off completely. Now, after that 4-year mark, you can basically repeat the cycle. Max it out again and buy another 5 mobile homes. You now have a total of 10 mobile homes, all giving you $1,000 per month. Now, the mortgage obviously is going to go up because you have debts on more property now. But at the end of the day, your profits per month jump all the way up to $5,300 per month. Now again, put that back into your home equity line of credit and pay it off as soon as possible. This time, because more money is going in, instead of 4 years, you pay it off in 2 years. And heck, if we do it again, we now have 15 mobile homes and our profits are about $8,000 per month, and we could pay off this home equity line of credit in just over a year. Now we're currently just over 7 years into this 10-year draw period, so we could theoretically do it 3 more times. Now if we fast forward to the end of this draw period, we now have 30 mobile homes all paying $1,000 per month. They're paying themselves off and giving you a profit of over $16,000 per month. And yes, you're in a lot of debt because you have a lot of different mortgages, but you now cash flow like crazy, as well as all those properties are paying themselves off. So it's good debt, cash flowing assets, and in 10 years time, you went from a single house with $100,000 in equity to over $3 million in equity and generating $16,000 in cash flow per month. Now, all this sounds amazing and it kind of sounds too good to be true. And there is quite a bit that I left out. As an example, with any rental, you want to factor in the worst case scenario. You want to factor in vacancy rates, repairs, HOAs, so on and so forth. So there's a lot of math that goes into making this dream a reality. But if we stick to just talking about home equity lines of credit, there's also more that goes into it as well. Home equity lines of credit are actually revolving lines of credit and not fixed interest rates. Meaning, just like a credit card or a personal line of credit, the interest rate that you pay is variable. So depending on which direction interest rates go can affect the interest rate that you're paying on this home equity line of credit. Now, different banks have different rules when it comes to these home equity line of credits and what interest rates they're attached to. Some banks, very few, attach it to the prime rate. Even fewer attach it to the federal funds rate. And the majority of home equity line of credits were attached to the LIBOR rate, but are now attached to the SOFR rate, the secured overnight financing rate. Now I have an entire playlist on my channel explaining to you what each of these rates mean, as well as 2 bonus videos on why I think the SOFR rate is set to go parabolic, meaning it's going to go straight up. Now currently the SOFR rate is extremely low. I believe it's less than 1%. But pre-COVID history shows us that it can skyrocket overnight without any reason. So can you imagine having $100,000 in debt on this home equity line of credit, and then the interest rates skyrocket overnight? Now, in order for it to go from the SOFR rate to your actual home equity line of credit, it's not going to be overnight. There's going to be a process. But still, can you imagine that having $100,000 in debt and then still your interest rate skyrockets? That's why in between every step I said, let's pay that thing off as soon as possible. That way you're just stuck with the 30-year fixed you have on your original home that you started off with, nothing in your home equity line of credit, and then all the 30-year fixed that you have in these mobile homes. I hope you got value in this video, and I really hope I helped open your eyes to the possibilities that come with being a homeowner and then using a home equity line of credit as a second lien behind your 30-year fixed to really generate a massive amount of wealth extremely quickly. If you got value, please remember to like and subscribe because it really helps this channel get out there even further. I have a dedicated Facebook and Instagram account. I don't post there too often, but if you ever had a question, comment, or just wanted something addressed, or even wanted to recommend a topic for a later video, feel free to message me there, as the YouTube comment section can kind of get confusing, replying and everyone talking over each other. Either way though, the choice is yours, and I'll see you in the next episode.